The insurance agent is waiting outside and he is here to collect the first installment check. But if you don't want to regret your decision later, watch this video before you finalize the deal. In India, traditional life insurance policies are a combination of insurance and investment. These include endowment plans, money back plans, and whole life insurance plans. The difference between these schemes lies in the timing of the cash receipts, but ultimately they are similar in the sense that they combine insurance and investment. I knew that these products generally give low returns, but how low was a truth that I realized only a few years ago when a policy held by my dad matured. This was a money back policy taken from Life Insurance Corporation in 2008 and had an annual premium of approximately 13,000 rupees to be paid for 12 years. And if we look at the returns, we received 22,500 once in 2012 and once in 2016. And in 2020, when the policy matured, we received another 1.23 lakhs. If we compare the total payment that we made and the total cash received, the surplus or profit is around 13,000 rupees. So the internal rate of return, or nothing but the effective interest rate that we received on this investment, it was just 1.76%. In other words, making a profit of 13,000 rupees after investing almost 13,000 every year for 12 years is only as good as getting an interest rate of 1.76% on my investments. To understand how bad this is, let us compare it with alternative investment options and see how much returns that would have gotten us. Starting with savings bank account. We all know that it gives very minimal returns of 3.5%. But still, if we had put the same money in a savings account instead of taking this policy, we would have made around 28,000 rupees compared to 13,000 we got from the insurance policy. What about FDs? We could have got more than 8% per annum and the surplus would have been almost 80,000 rupees. Similarly, choosing a random debt mutual fund would have given 8.35%, and investing in blue chip equity mutual fund would have given us 11.2% per annum, resulting in a profit of 1.24 lakhs. Now you may ask, what about taxation? Returns from insurance policies are completely tax-free, but you have to pay tax on other instruments. So I have calculated the tax adjusted returns as well. We have the pre-tax and post-tax returns side by side for comparison. In insurance policy, of course, there is no tax, so your returns are the same. But your savings account and FD returns will get taxed. I have assumed that the income belongs to 20% tax bracket and calculated accordingly. Here you can see that the returns have come down after tax. Like in savings account, it came down to 21,000 and in FDs it came down to 60,000. But still, it is much better than the insurance returns. In case of debt mutual fund, you have to pay around 20% tax, but only on the profit over and above the inflation rate. So between 2008 and 2020, the inflation was around 6.7% per annum. So if we earned 6.7% or less, we don't have to pay any tax at all. But in this case, since the mutual fund would have given us almost 8.35%, there will be 20% tax on the excess 1.8%. That will work out to roughly around 3.2% of the total profit, which is frankly quite low. But starting from April 2013, the government has removed the tax benefits available for debt mutual funds. This puts debt mutual funds in the same category as that of FDs going forward. And if we invested in equity mutual funds, until 2018, there was no tax at all. But today, we have to pay 10% tax, but only on your profits more than 1 lakh rupees in a year. To show you the worst case scenario, I have assumed that we had to pay this tax even during those days and made the calculations accordingly. So even if this tax rule was applicable in those days, you will have to pay tax on only 24,000, which will be 2,400, which is effectively just 1.9% of the total profit. And your returns will be as high as 11%, and your after-tax profit will be 1.21 lakhs. So a small difference in the decision taken in 2008 could have left us richer by more than 1 lakh rupees. Wait a minute. Please don't think that I am recommending you to jump into stock market right away. Stock markets and mutual funds have their own risk and there is proper technique to invest in them. So please don't jump into it without testing the waters. But I hope you can see how disappointing this policy was in terms of returns, even if we factor the tax benefits of insurance policies. If you had taken such a policy in the past and it matured, please let me know in the comments below how much returns you got. Coming back, there are some more disadvantages when it comes to these schemes. For example, there is no way you can track the returns or performance of these policies live. In case of mutual funds, the net asset value or NAV is updated every day. NAV is similar to share price. How share price is for companies, NAV is for mutual funds. Because this NAV is published every day, you can check how well your fund is performing whenever you want. And if you're not satisfied with the performance, you can switch to something else which is doing better. For bank deposits, the returns are known upfront, and that will not change once a deposit is made. So nothing to worry about there. But for insurance policies, you won't get to know the returns at all until the end of the policy, which may be 15 or 20 years later. And by the time you realize that the returns are too low, it's already too late. I'm sure that if we came to know that our investment was growing at only 1 or 2% per annum, we would have quit long ago. In a way, if you have taken these policies, you have just gambled and taken a bet, and now you're just hoping to get good returns. The next aspect to consider is liquidity. So what is liquidity? Liquidity refers to the ability to withdraw money easily when required without much loss. Land, for example, is not liquid because if you want to sell it overnight, it won't be possible. And even if you want to desperately sell it, you might take a huge loss. FDs, on the other hand, are very liquid because you can easily break a deposit, and the penalty is also quite low, around 1%. Debt mutual funds are of many types, and there are very liquid funds where you can even deposit money today and withdraw it tomorrow without any penalty. But in some cases, there is 15, 30 or 90 days timeline before which there is a 1% penalty if you withdraw. This penalty is called exit load. But if you are withdrawing after the specified timeline, there is no exit load. In case of equity mutual funds, if you withdraw it before 1 year from the date of deposit, the exit load will be around 1%. But if you withdraw it after a year, generally there is no exit load. But this 1% is nothing compared to the losses you can make on insurance policies. In case of the policy that we had, if we surrendered it before 3 years, we would have lost the entire 100% premium paid. If we surrendered it after 3 years, we would have still lost around 50 to 80% of the amount paid. There is also an option to convert the policy into a paid-up policy after 3 years. But in such case, the maturity value will reduce significantly and we would still be losing around 20 to 30% of the amount. Now let's consider the opposite scenario where the policy has matured and they are giving us the money, but we don't need the money right now and prefer to stay invested for longer. There is no such option available with insurance policies. But in case of mutual funds and bank deposits, you have complete control over how long you want to stay invested. And this policy is a perfect example to show how useful this feature can be. Remember I told you that we would have got 11% returns in equity mutual fund? This was if we exited in August 20. This was a time when the markets were down 6 to 7% after COVID and was on its recovery path. So if we didn't urgently need the money in August 20 and held on to it for another 6 months, our returns would have been much higher. This would have translated to 15.2% returns post-tax and in absolute terms 2 lakh rupees. So in conclusion, with such weak returns, even after factoring the tax benefits, inability to monitor the performance regularly, and poor flexibility to switch or to stay invested for longer, insurance policies are the worst investment option you have in the market. So far, we have only looked at the investment angle of the policy. Now let us look at the insurance aspect. First of all, what is insurance? It is an instrument meant to protect your wealth from risks and uncertainties. In the case of life insurance, it is meant to protect the dependents of the family from the loss of financial stability that may arise from loss of life. This risk of loss of life is a constant threat for all of us. It could be an accident or a disease like COVID, or sometimes even without any reason. And the risk becomes much more severe if the entire family is dependent on a single person for all their financial needs. because if something unfortunate were to happen to this income earning person, the rest of the dependents could literally end up on streets. For most middle class families, the savings alone won't be sufficient to take care of all the future financial needs. They might still survive with the help of friends and relatives, but nobody will go out of their way to send the kids to the best universities or to ensure that they have the best possible life. This is where life insurance can come to the rescue, but only if you have sufficient coverage. Having 1 or 2 lakh sum assured today is like taking a 10,000 rupees insurance coverage on a car that costs 10 lakh rupees. Specifically in our case, we needed maybe around 60 to 70 lakh coverage at that time based on our expenses. And what we had was just 1.5 lakh coverage. When the 1.5 lakh money back policy itself costed us almost 13,000, a 60 or 70 lakh policy would have had an annual premium of around 5 to 6 lakh rupees, which was definitely not affordable for us. So this policy, which had a 1.5 lakh sum assured, definitely failed from an insurance angle as well. And because of that, we remained under-insured throughout all these years. And this is the reality of most Indians. Most of us hold multiple such policies, but we are not adequately covered. So why does this happen, and how did most of us end up with such policies? The first problem is the marketing techniques of these insurance companies. The names are so deceptive. Money back, guaranteed returns, double income benefit, smart income. All these names sound very attractive, so we get tricked easily. Second issue is the agents. Insurance agents get really good commission for these traditional insurance schemes, sometimes even 25% of the first premium payment you make. So they will always push for these products which give them the highest benefit, even though it may not be suitable for you. I don't blame the insurance agents because they are just doing their job for their income, but it is our responsibility to ensure that we do the required analysis before buying something. And that brings me to the final and most important issue, lack of knowledge. Most of us, including the agents, don't know how to calculate IRR or ROI from the cash flows. We don't have the financial skills to evaluate and compare different investment options. We don't know how to weigh the risks and benefits, and we get easily influenced by fancy brochures or recommendations of relatives. Now that we know the causes, I hope we can build mental defenses against these tricks going forward and not fall for them. So what is the solution and what is the alternative we have? It is a simple, plain vanilla term insurance. These are pure insurance schemes that only pay out if the insured person loses his or her life. Just like you don't get any returns from vehicle insurance, you don't get any returns here. But don't be discouraged by that, because they are quite cheap compared to the traditional policies. So cheap that most of you will be able to afford the coverage that you require. For comparison, a 26-year-old will have to pay a premium of only around 12,000 if he wants to take a term insurance of 75 lakhs. But under an endowment scheme, it will cost him around 4.8 lakhs for a 75 lakh policy. This is 40 times costlier and no one can afford this. But still, if you are reluctant, thinking that you will lose the entire money and not get any returns, you need to realize that even when you take an endowment policy, they keep aside a portion of the premium you pay towards the insurance risk, and you will never get that money back. Only remaining money is invested on which you will get returns. It's just that this breakup is not disclosed, so you don't realize that it's happening. Also, I have some calculations that can ease your mind. Let's assume you decide to go ahead with the endowment option and invest 4.8 lakh for a 75 lakh coverage. And let's assume you get 2.5% returns per annum. As you saw earlier, our returns was only 1.8%, but I'm assuming you will be more lucky than me and you will get 2.5%. At the end of 20 years, you will be left with 1.23 crores. On the other hand, I will go with a term insurance and pay 12,000 premium every year. On this, I'm not going to get any returns. But compared to you, I will be left with additional savings of 4.68 lakhs, which I can invest in a mutual fund every year. You already saw that the returns can be as high as 15%. But let's assume I'm unlucky and I get only 8% returns after tax. I will still be left with 2.14 crore after 20 years. And if actual returns turn out to be 12 or 15%, the numbers are going to be mind-boggling. So the main lesson I will leave you with is this. Don't combine insurance and investment. Keep them separate and you can enjoy the best of both worlds. Now, coming back to the agent who is waiting at the door, I think you have three options. 1. The agent came to you with a term insurance. In this case, it's a good decision and I hope you have enough coverage. 2. The agent is there with an endowment or money back scheme or some other variant of it with a fancy new name, in case of which,
run.
Or if you don't know what kind of product it is and you haven't made up your mind, you want to learn how to do all these calculations of IRR or projected returns, you can subscribe to my channel and check out the other videos and ask the agent to come back another time when you will be able to have a much more intelligent discussion with him.